Amazon. Amazon has lost billions of dollars on several ambitious projects over the years. One of its biggest failures was the Fire Phone, launched in 2014 to compete with Apple's iPhone and Samsung's Galaxy devices. The phone failed to attract customers, forcing Amazon to write off around $170 million and take additional inventory losses. The company also invested heavily in physical retail stores and other experimental projects that were later scaled back. Although Amazon remains one of the world's most valuable companies, these failed bets show that even successful businesses can spend billions pursuing ideas that never take off. Microsoft. Microsoft has experienced several billion-dollar setbacks despite its long-term success. One of the largest came after it acquired Nokia's mobile phone business for more than $7 billion in an attempt to compete in the smartphone market. The strategy failed, and Microsoft eventually wrote off almost the entire value of the acquisition, while cutting thousands of jobs. The company also invested heavily in products like the Zune music player and Windows Phone, but neither managed to challenge Apple's iPhone or Google's Android ecosystem. These costly failures reshaped Microsoft's strategy and pushed the company toward cloud computing and artificial intelligence. Meta. Meta has spent tens of billions of dollars building its vision of the metaverse through its Reality Labs division. The company invested heavily in virtual reality headsets, software, and digital worlds, believing they would become the future of computing. However, consumer adoption has been much slower than expected, and the division has reported operating losses exceeding $60 billion over several years. While Meta continues investing in the technology, the scale of these losses makes it one of the largest long-term bets in the history of the tech industry. Google. Google is known for innovation, but it has also spent billions on products that never became successful. Google Glass was introduced as a revolutionary wearable computer that promised to change the way people interacted with technology. Despite the excitement surrounding its launch, concerns about privacy, limited functionality, and its high price prevented widespread adoption. The company later shifted the product toward business customers before quietly ending development. Google also invested heavily in Stadia, its cloud gaming platform, building powerful data centers and funding game development studios. Yet the service struggled to attract enough players and was eventually shut down. Alongside these projects, Google has canceled dozens of other products after years of development, showing that experimentation often comes with enormous financial risks. Apple. Although Apple is one of the world's most profitable companies, it has not avoided billion-dollar losses. For nearly a decade, the company secretly worked on developing an electric vehicle under Project Titan. Thousands of engineers were hired, advanced technologies were developed, and billions of dollars were invested in research, battery technology, self-driving systems, and vehicle design. Despite years of work, Apple reportedly concluded that the project was no longer commercially viable and canceled it before releasing a single car. Walking away from such a massive investment demonstrated that even the world's most valuable technology companies sometimes decide that continuing a project would cost even more than ending it. Intel. Intel dominated the computer processor industry for decades, but delays in manufacturing technology proved extremely costly. While competitors such as AMD designed increasingly powerful processors using factories operated by TSMC, Intel struggled to transition to smaller and more advanced manufacturing processes. The delays allowed rivals to gain market share in personal computers, servers, and data centers. In response, Intel committed tens of billions of dollars to building new semiconductor factories and modernizing its production capabilities. These investments, combined with declining sales and shrinking profits during certain periods, resulted in billions of dollars in financial losses and significantly reduced investor confidence. IBM. IBM has spent decades reinventing itself as technology has evolved. After dominating the personal computer market in earlier years, the company gradually shifted toward enterprise software, consulting services, cloud computing, and artificial intelligence. This transformation required billions of dollars in acquisitions, research, and restructuring. Some of these investments produced strong results, while others failed to meet expectations. IBM's Watson artificial intelligence platform, for example, generated enormous attention but struggled to achieve the widespread commercial success many had predicted. The company also invested heavily in new technologies that required years before generating meaningful returns, making its transformation both expensive and challenging. Yahoo! Yahoo was once one of the most powerful companies on the internet, yet it lost billions largely because of poor strategic decisions. During the early years of the internet, Yahoo dominated online search, news, email, and advertising. However, it failed to recognize the growing importance of Google's search technology, and later underestimated Facebook's influence in social media. The company famously passed on opportunities to acquire both Google and Facebook when they were still relatively small businesses. As competitors continued growing, Yahoo's advertising revenue declined, its market value collapsed, and its core internet business was eventually sold to Verizon for only a fraction of what the company had once been worth. BlackBerry. BlackBerry once controlled the global smartphone market and was especially popular among business professionals and government officials. Its secure messaging system and physical keyboard made it one of the most recognizable technology brands in the world. However, the company underestimated the impact of Apple's touchscreen iPhone and Google's Android operating system. BlackBerry continued focusing on keyboard-based devices while consumer preferences changed rapidly. Sales declined year after year, forcing the company to write down billions of dollars in unsold inventory, close factories, reduce its workforce, and eventually exit the consumer smartphone market entirely. Nokia. Nokia was the world's largest mobile phone manufacturer before smartphones transformed the industry. The company built its reputation on reliable, durable mobile phones that sold in nearly every country. However, Nokia reacted too slowly when Apple introduced the iPhone and Google expanded Android. Its own Symbian operating system quickly became outdated, and newer products failed to compete with rival devices. As sales collapsed, Nokia lost billions of dollars in revenue and market value before eventually selling its mobile phone division to Microsoft. Ironically, Microsoft's own smartphone strategy also failed, turning the acquisition into another billion-dollar loss. Sony. Sony has experienced billion-dollar losses from several different parts of its business. The company's electronics division struggled against increasing competition from manufacturers producing cheaper televisions, smartphones, and computers. At the same time, Sony became the victim of a major cyber attack that exposed confidential company information, disrupted operations, and damaged its reputation worldwide. Combined with declining sales in several product categories, these challenges forced Sony to restructure parts of its business, sell assets, and reduce costs before eventually returning to stronger financial performance through gaming, entertainment, and image sensor technology. Tesla. Tesla's financial losses have come from both investments and market strategy. In 2021, the company purchased approximately $1.5 billion worth of Bitcoin, expecting digital assets to become an important part of the future economy. When cryptocurrency prices fell sharply, Tesla recorded significant impairment losses and later sold part of its holdings. The company has also repeatedly reduced vehicle prices around the world to remain competitive against growing electric vehicle competition. While these price cuts helped increase sales volumes, they also reduced profit margins by billions of dollars, illustrating the difficult balance between growth and profitability.